Right now, there is a number sitting inside the silver market that almost nobody is talking about. And if you understand what it means, you will look at every headline about gold and silver differently for the rest of this year. 6 years in a row, 6 consecutive years where the world has used more silver than it has dug out of the ground. Not once, not twice, 6 years straight, and 2026 is on track to be the 6th. That kind of run has never happened in the modern history of this market, and yet silver just fell more than 40% from its all-time high, and most people watching that price on their phone assume the story is over. They think the rally failed, they think the opportunity is past. I'm going to show you why that assumption might be exactly backwards, and why some of the same institutions that were calling for triple-digit silver a few months ago are now saying the real setup is only beginning. Welcome to Gold and Silver Intelligence. If you want to understand what's actually happening beneath the surface of this market, and not just what the ticker is telling you, stick around, hit subscribe, and tap that like button right now, because what I'm about to walk you through connects a Federal Reserve chair, a Chinese export policy, a nuclear reactor, and a warehouse in London. And by the end, you'll see exactly why they're all part of the same story. Let's start with the number itself, because context is everything here. Silver spent 2025 doing something it hasn't done since 1979. It surged more than 120% in a single year. Then it kept climbing into January of 2026, briefly punching through the psychologically massive $100 an ounce level for the first time ever, eventually touching an all-time high above $120. For a metal that traded in the 20s and 30s for most of the last decade, this was historic. And then came the drop. A sharp, brutal repricing that knocked more than 40% off the top, dragging silver back down into the 60s and 70s. Here's where things get interesting. Because if you only look at the price chart, this looks like a bubble that popped. But if you look at what was actually happening underneath that price chart, in the mines, in the vaults, in the refineries, a completely different picture starts to emerge. And that difference is the entire reason this video exists. To understand why, you need to understand what a structural deficit actually means, because this phrase gets thrown around a lot and most people don't grasp how unusual it really is. Every year, the world consumes silver for jewelry, for coins and bars that investors buy, and increasingly for industrial uses like solar panels, electric vehicles, and electronics. Every year, mines and recyclers produce silver to meet that demand. In a healthy, balanced market, those two numbers move roughly together. But since 2021, they haven't. Demand has outpaced supply every single year, and the gap has been covered by drawing down stockpiles that were built up over decades. According to the Silver Institute's own survey data, the cumulative shortfall from 2021 through 2025 alone adds up to more than 800 million ounces. Think about that. 800 million ounces pulled out of the world's above-ground reserves just to keep the market functioning. And the projection for 2026, even after several analysts trimmed their estimates, still points to a 6th consecutive deficit year. That is not a temporary blip. That is a structural feature of this market that has been building for half a decade, and it is still not resolved. Now here's the detail most people miss when they look at those revised, smaller deficit numbers and assume the danger has passed. A shrinking deficit is not the same thing as a surplus. Even the more conservative estimates for 2026 still show demand running ahead of supply. The debate among analysts isn't whether there's a shortfall, it's how big the shortfall is. Some forecasts have it near 46 million ounces. Others put it closer to 70. One analysis even suggested it could widen toward 200 million ounces if certain supply channels get disrupted. But in every single version of this story, silver goes into 2026 already short. The market is entering its 6th straight year in a hole, and it still hasn't climbed out. That alone would be a significant story. But something else happened that made this situation dramatically more urgent, and it has almost nothing to do with jewelry or coins. It has to do with why the world suddenly needs so much more silver than it used to. 60% of all the silver consumed on this planet doesn't go into rings or necklaces or investment bars. It goes into industry, and the two industries driving that demand higher are two of the biggest technological shifts of our generation: solar power and artificial intelligence. Silver is one of the best electrical conductors on Earth, which is exactly why it's used as a paste on solar panels to capture and move electricity, and exactly why it's essential in the high-performance electronics that power data centers. Back in 2016, solar demand for silver was around 80 million ounces a year. By recent estimates, that number has climbed to roughly 200 million ounces annually, more than doubling in less than a decade. At the same time, the explosion in AI infrastructure has created a new and rapidly growing appetite for silver in server components, semiconductors, and the electrical systems needed to run massive computing facilities. This is where the individual story becomes something much bigger. This isn't just about people buying silver coins as a hedge against inflation anymore. This is about whether the physical world has enough of a critical metal to build the energy grid and the computing infrastructure that the next decade depends on. But here's where the plot thickens even further, because industrial demand alone doesn't explain everything that happened in early 2026. There's a second force at work, and it involves the kind of players who almost never touch silver at all. For 70 years, there has been an unwritten rule in global finance. Central banks buy gold. They do not buy silver. Gold is treated as the ultimate reserve asset, the symbol of monetary power, the thing nations hoard when they don't trust paper currencies. Silver, by comparison, has long been dismissed as the poor man's gold, useful mostly for industry and small investors. In early 2026, that 70-year-old rule started to crack. As geopolitical tensions rose and some central banks, facing sanctions and de-dollarization pressure, began searching for assets outside the traditional dollar system, silver started appearing on the radar in a way it hadn't before. When an asset that has never been part of the central bank playbook suddenly starts getting a second look from monetary authorities, that is not a small development. That is a signal that the entire identity of this metal is shifting, from a simple industrial commodity into something with monetary and strategic weight as well. And then, layered on top of the industrial surge and the emerging central bank interest, came a third and completely different kind of pressure: politics. In 2025, uncertainty around potential tariffs on US silver imports, tied to broader trade and critical minerals policy, triggered something unusual. Large amounts of physical silver began moving from London, which has traditionally been the main hub for physical metal, over to New York, where the futures contracts are settled. Traders were hedging against the risk of a tariff creating a price gap between the two markets. But that movement of metal had a side effect nobody fully priced in at the time. It drained liquidity out of London specifically. And a market that had already been running a structural deficit for years suddenly found its most important physical trading hub becoming tighter and more illiquid than it had been in a very long time. Combine years of drawn-down inventories with a sudden liquidity squeeze in the world's main physical trading center, and you get exactly the kind of environment where a spark, whether it's a hedge fund's momentum trade or a wave of retail investor enthusiasm, can send prices exploding in a very short period of time. That, according to analysts who track this market closely, is precisely what helped ignite the historic move into January of 2026. So now we have three separate forces stacking on top of each other. A structural supply deficit stretching back 6 years, a wave of industrial demand from solar and AI that shows no signs of slowing, and a physical liquidity squeeze in the market's most important trading hub. Three individual stories, but together they form something much bigger than any one of them alone. Now, at first glance, the sharp 40% pullback after the January peak seems to contradict everything I just told you. If the fundamentals are this strong, why did the price crash so hard? This is where most retail investors get the story completely backwards, and where you need to pay very close attention, because the explanation reveals something crucial about how commodity markets actually work. Here is the part most people never learn. A supply deficit being real does not automatically mean the price only goes up. What actually moves the price in the short term is the gap between what the market expects and what actually happens next. Going into 2026, many traders had positioned themselves for an even larger deficit than what several institutions ultimately projected. When some of the largest banks revised their deficit estimates down, from earlier figures near 300 million ounces to more modest numbers in the 60 to 70 million ounce range, that revision didn't mean the market flipped into a surplus. It simply meant the deficit was smaller than the most bullish traders had bet on. And when expectations get walked back like that, even in a market that remains technically undersupplied, the price can fall sharply as that excess optimism gets squeezed out of the system. On top of that, changes in expectations around the Federal Reserve added enormous volatility. A new Fed chair nomination in early 2026 raised fears of a more hawkish path for interest rates, and because silver, unlike gold, has a much larger investment component that is highly sensitive to rate expectations, that fear triggered a sharp sell-off, even while the actual physical market, the mines, the solar panels, the data centers, kept consuming silver at the same relentless pace as before. This is the single most important distinction in this entire story, so let's make it as clear as possible. There are two silver markets happening at the same time. One is the paper market, driven by traders, interest rate speculation, and short-term positioning, and that market can swing wildly in a matter of days based on a single political headline. The other is the physical market, driven by solar installations, AI data centers, electric vehicles, and jewelry counters around the world, and that market barely blinks when the Fed makes an announcement. The physical market has been running short for 6 straight years and shows no sign of flipping into surplus anytime soon. The paper market just had one of its most violent corrections in years, and right now, those two markets are telling two very different stories about where things go from here. Here's why that gap matters so much. Historically, when a rate-sensitive sell-off hits a metal that remains physically undersupplied, the price compression created by that sell-off doesn't resolve the underlying scarcity. It just delays the moment when that scarcity forces its way back into the price. Several of the institutions that follow this market closely have pointed to exactly this kind of setup as historically preceding periods where the metal significantly outperforms once the rate-driven fear fades. And there's a specific number that makes this even more compelling. The relationship between gold and silver prices, known as the gold-to-silver ratio, is one of the oldest tools in precious metals analysis. Historically, that ratio has averaged somewhere in the 60s. At the peak of silver's rally, that ratio actually fell below 50, meaning silver had become expensive relative to gold by historical standards. After the correction, the ratio moved back out toward the 60s, putting silver at a level that several analysts consider modestly undervalued relative to gold once again. That's not a guarantee of anything. Markets can stay undervalued or overvalued for a long time, but it is exactly the kind of signal that has, in the past, preceded periods where silver plays catch-up. But that's still not the biggest piece of this puzzle. There's one more layer, and it might be the most underappreciated of all: China. For years, China has been both a major producer and a major consumer of refined silver, and much of the rest of the world has quietly depended on Chinese refined metal to help plug gaps in the global supply chain. In 2026, China began reclassifying silver as a strategic material and tightening restrictions on exports. Think about what that actually means. At the exact moment the rest of the world is already running its 6th consecutive year of deficit, one of the largest suppliers of refined silver is choosing to keep more of it inside its own borders. That is not a minor supply chain adjustment. That is a structural shift in who controls access to a metal that solar manufacturers, electronics makers, and AI infrastructure builders across the entire world depend on. If those restrictions persist or tighten further, the deficit that analysts are currently projecting could turn out to be too conservative, not too aggressive. Now put all of these threads together, because this is where the individual story becomes a global one. What started as a simple supply and demand imbalance in a niche precious metals market has grown into something touching some of the most powerful forces on the planet. The clean energy transition, which needs silver for solar panels. The artificial intelligence boom, which needs silver for the infrastructure powering every major AI data center being built right now. Central banks quietly stepping outside a 70-year-old playbook to consider silver as a strategic and monetary asset for the first time in generations. And now a major world power restricting the flow of a critical metal at the exact moment global industry needs more of it than ever before. This is no longer just a story about coin collectors and jewelry demand. This is a story about who controls a metal that sits at the intersection of energy, technology, and geopolitics. If you're finding this as fascinating as I do, drop a comment below and tell me which part of this surprised you the most. Was it the 6 straight years of deficit? Was it central banks quietly stepping into silver for the first time in 70 years? Or was it China's export restrictions landing at the worst possible moment for global supply? I read every comment and I want to know where you stand. So where does this actually go from here? Because building the case is one thing, but you deserve to see the range of outcomes analysts are actually putting on the table, not just the exciting version of the story. On the bullish side, several major institutions have laid out scenarios where continued physical tightness, a Federal Reserve that eventually pivots toward cutting rates, and persistent industrial demand from solar and AI combine to push silver back toward, and potentially beyond, its January highs by the end of the year, with some year-end targets clustering in the $90 to over $100 range, and more aggressive scenarios from certain banks stretching considerably higher if physical shortages intensify further. On the more cautious side, if geopolitical tensions ease, if oil prices stay contained, and if the Fed signals a willingness to keep rates higher for longer, some analysts see silver retesting support in the $60 to $63 range before any further move higher. The honest answer is that nobody has a crystal ball here, and anyone promising you a guaranteed number is not being straight with you. What we can say with much more confidence is the structural piece of this puzzle. 6 consecutive years of deficit. Industrial demand from 2 of the biggest technology shifts of this era, a physical market in London that has been stretched thinner than it has in years, and a major supplier now restricting exports at the worst possible time. Those forces don't simply disappear because of a few volatile weeks driven by Federal Reserve speculation. They play out over years, not days. And this is exactly why so many long-term investors treat silver differently than a short-term trade. The structural case here isn't about calling the exact bottom or the exact top of a single volatile month. It's about recognizing that a metal essential to solar energy, artificial intelligence, electric vehicles, and now potentially central bank reserves has been running short for 6 years in a row, while the world's need for it accelerates. That is the kind of imbalance that historically does not resolve quietly. Before we wrap up, if this kind of analysis is valuable to you, share this video with someone who's been asking you about precious metals lately, because this is exactly the context most headlines leave out. They'll show you the price, they won't show you the deficit, the ratio, the export restrictions, or the central banks quietly changing their playbook. So here's the bigger picture, the one most people scrolling past a silver price chart will never stop long enough to see. Silver just went through one of its most violent corrections in years, and on the surface that scared a lot of people out of the market entirely. But underneath that price action, the physical world has now gone 6 consecutive years without producing enough silver to meet the demand from solar panels, electric vehicles, and the artificial intelligence infrastructure being built right now, on top of everything else. Central banks, for the first time in 70 years, are starting to look at this metal differently, and one of the world's largest suppliers just began restricting how much of it leaves its borders. None of that changed because of a few weeks of interest rate speculation. If anything, the correction may have simply reset the price to a level where the actual structural story can reassert itself. Whether that happens in the next few months or takes longer to play out, the imbalance underneath this market hasn't gone away. It's still sitting there, quietly building, waiting for the moment the paper market and the physical market finally have to agree on the same price again. So here's my question for you. Knowing what you now know about the 6-year deficit, the AI and solar demand surge, the central bank shift, and China's export restrictions, do you think the recent pullback in silver is a warning sign, or the setup most people are going to miss? Let me know in the comments, hit subscribe if you want to stay ahead of this story as it develops, and if you found this valuable, share it with someone who needs to see the full picture, not just the headline. This is Gold and Silver Intelligence, and I'll see you in the next one.